Good morning, everyone, and welcome to our Family Business Learning Community. I'm Sally Durstein. I lead our team here at the Family Business Center, and I'm delighted that you're joining us, whether you are live or whether you're watching this later on recorded. I'd like to begin by honoring and blessing mothers. I know we're coming off of Mother's Day, and by the way, fun fact, did you know that Mother's Day has its roots in Philadelphia? Anna Jarvis from Philadelphia, her mother organized women's groups promoting friendship and health. And so she held a special memorial service for her mom on May 12, 1907. And by 1914, Woodrow Wilson made it a national holiday. I thought that was kind of interesting. Well, many of us really enjoyed Mother's Day. It was a good time of appreciation and family time. I know that was for me. But for some of us, Mother's Day is very painful. We've either lost our mother, or we have a frayed relationship or a distant relationship, or we'd like to be a mother, and we haven't been able to do that yet. Well, I would venture to say that most of our businesses and our families would not be what they are today without our mothers. In my work with family businesses, and particularly mothers over the past 30 years, mothers have sacrificed a lot for the business, for the family. Often their input is incredibly helpful, whether it's in the office or strategic planning. But often more importantly, they are nurturing the family side of the business. They're nurturing the next generation, developing them into being fine folks with values. And so I would just special hats off to mothers and for their sacrifice and what they continue to contribute, again, often invisible. And I would also challenge each of you to reach out to not only your mom on a non-Mother's Day, but perhaps 2 or 3 other important family women in your life. I encourage you to reach out today to 2 or 3 family, maybe aunts, maybe cousins who have impacted you and continue to impact you. And by the way, when you're done, I encourage you to send me an email that just says done. Because as you know, our theme this year is on accountability. And so that will be your light accountability to email me. Well, I'd also like to begin by saying that not only is our theme accountability, but I'm really grateful for our EDU sponsors who contribute to our programs. They're listed here on the slide. And we have 2 of them presenting today. We vetted them for their expertise and their collaboration and also their knowledge of family business dynamics. So today's program, we are going to hear from Steve Stigaitis from Kreischer Miller and from Andrew Grau from HRM&L. I've worked closely with Steve and Andrew for many years and also have done presentations with them. Steve is a leader in Kreischer Miller's family business practice. Among other things, he helps companies analyze and understand their financial position. He assists with business valuations. He structures business transfer plans for family businesses. And Andrew is a partner with HRM&L's Business and Estates Department. Andrew enjoys the unique challenges that family businesses present. He provides lots of great legal counsel, and he often plays the defense coordinator, providing protection in how he drafts contracts. So just a word about context. I'd like to provide some Five Mountain context. Acquisitions are risky. Now, you might view them as a Blue Mountain, a management responsibility, but acquisitions require high levels of communication and coordination across the mountains. Acquisitions involve expending capital to acquire, whether it's customers, plants, new technology, and that requires thoughtful consideration by the management, the board, and the shareholder mountains. And I might add by the advisor mountains. And that's part of what we're bringing today, value in that. I would say most acquisitions fail because of lack of cultural alignment in family business. The shareholders need to be clear about the culture they want, so shareholders need to vet acquisitions as well. And just a brief story, I serve on a family business board, which recently acquired another family business. Now, they've been successful with us. I believe they will continue to be successful, not only because they're doing what we're presenting today, but also because there is a high level of congruence in values and culture between the businesses. So a word as we move throughout the morning, you are welcome to ask questions. There's a Q&A button probably at the bottom of your screen or maybe at the top, depending on what you're using. So just click on that, type in your question. We might hold them till the end. If we see, we'll be answering them earlier on. And please do know that you will have access to this program afterward. Karen will send you out a brief survey so that we can continue to serve you well. And I'd also like to just thank you for those of you who have completed our survey around events and how we're opening up and maybe doing hybrid events in the near future. Really appreciate that. If you haven't filled it out and you can't find it, please ask and Karen will send another one to you. So Steve, I am going to turn it over to you.
Great. Thank you, Sally. Good morning, everyone. Good morning, Andrew. So we were talking about at one of our meetings about topics of events, and I will tell you one of the big inspirations for the one we're going to discuss today really has to do with had so many clients over the years that have been so interested in wanting to pursue some type of acquisition. They've identified a business that they know is for sale, and in a lot of cases they've never gone through that process before and have asked the question, you know, what do I do? What are the things we should be thinking about? So that was somewhat of the inspiration, and I think coupled also with just what seems to be going on a lot in today's current economic environment. There seems to be a flurry of just activity of businesses being bought and sold right now. That merger and acquisition area has really not slowed down at all since probably last summer. Took a little pause, you know, in the months of March, April, and May even. But since then, we have just seen, at least in our client base, just a flurry of activity. And I think there's a handful of contributing factors that are adding to that. You know, from an owner perspective, they've been through a lot. The past 10, 12 years, owners have been through a recession, global recession. They're just coming out of navigating through a pandemic. And if you think about just the makeup of where most businesses are in terms of their life cycle, there's still a majority of businesses that were started and are owned by that baby boomer generation. And so just where they are at their point in the life, this seems to be a pretty prime time. And you couple that with very low interest rates and a lot of cash that investors have that they're looking to put to use, and it's really just added more fuel to that fire. So so a few things we did want to cover because of that. We do have quite a few family businesses that have been interested because they're not looking necessarily to use a sale as an exit strategy at this point in time anyway, but they are seeing some activity of some friendly competitors, if you will, that are thinking about getting out and have expressed some interest in wanting to pursue some acquisition. So this morning, we really just wanted to cover at a high level. I mean, this could be a whole week-long workshop of different topics, but just want to revisit some of the highlights. Review what are some of the reasons why you would consider making an acquisition. How do you go about thinking? How do we value a target? What should we think about, you know, from a pricing perspective? Beyond that, just taking a look at what are some of the different types of structures to be thinking about, and then some of the other final legal and risk considerations, financial considerations as well for those in pursuing those. So that's what we want to cover this morning. So I think next. So on the front end, I think it's so important to have that clarity as to why is it that you feel a acquisition is going to be helpful to you, right? We've listed here what are the more common reasons for why a business would pursue an acquisition, right? It's typically to expand into a new geographic market. So a friendly competitor that might have a footprint in a neighboring county or part of the country. It could be just a natural expansion and integration into existing products or services that your business is currently offering. So when you think about from a supply chain perspective, this could be a nice integration into, hey, look, instead of having to pay a third party to do this part of our process or buy this type of product, they can think about acquiring a company and integrate it into their operations. Right now, it could be to acquire a specific type of technology or process to, again, increase the competitive edge that you have. And especially in today's environment, there just seems to be, this has become a pretty common theme again, just our clients are having a real hard time finding access to good talent. And in a lot of cases, if there's a competitor that has a workforce already in place that's trained, knows what they're doing, an acquisition can be a way to bring in some much needed, hard to find talent. I am working with one client right now that they are the target of a larger company, and this is one of the main drivers for it. They do a very specialized service offering that this buyer has been trying to figure out now for a couple of years, and they are stumbling. And so our client is becoming the product of a target for them for that reason. The other reason, a little less common, although I see in private family-held companies, but certainly one that exists, is it can also be a way to eliminate some competition. Facebook, for instance, has been notorious for saying that this is not the reason for a lot of their acquisitions, and then there's usually some pending legal action after. But they are obviously, people know who Facebook is, but they are one that has been notorious for if they see a competitor, a disruptor in their industry, before it takes them out, they have the scale and size to acquire them, and they've done that multiple times over the years in order to do that. So, anything to add, Andrew? If I'm missing anything from that perspective?
No, not on this slide. Thanks, Steve, and good morning, everybody. We can move on to the next slide, which is just a general overview of the process from beginning to end. And Steve was talking a lot about what goes into identifying the target. And to add to that, as you're approaching a potential acquisition, the way you become aware of the target or introduced to the target is going to impact the way you approach, at least how you present your terms, what your offer is going to be. There's a difference between if it's a friendly competitor who you're aware of that approaches you and says that they're going to be getting out of the business, they're looking for a succession plan, and are you open to exploring an acquisition? In that type of an approach, the leverage is really all with the buyer, because they let it be known that they want to sell, they want to get out. It's quite different if you're making a concerted effort to find a suitable target. You have to entice them to even get to the table to begin with. You generally have to make a sweeter offer to the target if you're approaching them cold. And similar, if maybe you're patched into a process where a company wants to sell, they're almost being put up for auction. They may have a broker or a mergers and acquisitions consultant who's put together some materials to show the company in a positive light, and you may not be the only competitor trying to acquire this company. So knowing what the target situation is very important in how you come to the terms.
Yeah, can I just add one thing I've seen a lot, at least from my client base, is a lot of times when they have a friendly competitor, if you will, it's a process of just sometimes planting some seeds to them over a period of time and just saying, hey, listen, if you ever get to a point of wanting to exit, we'd be interested in talking to you. I think making just eliciting that, putting that out into the ether in terms of letting, they've had a lot of instances where those friendly competitors have reached a point and they remember that. I know and to Andrew's point too, a lot of times you want to understand the why a company is looking to sell. And we'll get into this a little bit later because it'll dovetail in nicely into understanding from a structure perspective how much flexibility you may have in those cases. But I've had one multi-generation, their fourth generation business was looking to buy a business from a pair of brothers that had started a company, and they had reached sort of the end of their working years. One of them did have some health issues. They knew they could sell to a private equity or to another larger company, but their concern was that they didn't want their business, that acquirer to just take over from their customers and shut down their operation and let go of their people. So for them, our client was a met needs beyond just the financial one. Our client was not able to pay the top price for it, but they did make commitments that resonated well with the seller to say, listen, we're a fourth generation business. We feel very obligated to have a presence in our community, and we understand, we'll hire your people. We have a need for your facility and operations. And that resonated really well with the selling company. And so there was a way we met just a handful of needs in that case. The other way that we see, if you have not been to identify a target, and I think, Andrew stated it well here, is the other alternative. A lot of times you can reach out and use the services of an intermediary, which can be helpful in finding you a target company to acquire as well, if you're not aware of one. More often than not, for my clients, they usually have some knowledge of the company that they're looking to buy, but that's not always the case. So.
Yeah, I've seen in my experience, the leading cause in seller's remorse after the deal is closed is what happens to the employees after the deal. And sometimes it's not right away. It can be a year later or even more. But changes are often implemented, and especially if you have private equity or a company where this represents a lot of commonality, where there's redundancy that's created in the acquisition. So being able to present yourself as a stable family business who takes good care of its employees and sees this as expanding its family can definitely help you be portrayed in a more positive light early on. If you're competing against other potential buyers, you may not necessarily have to be the highest offer in order to get the interest from the target. Once you move beyond the initial conversations, and sometimes this is even right away if you're patched into one of those intermediary situations is you have to have an NDA in place. And if you don't present it to the seller, they'll present it to you. An NDA is a non-disclosure agreement. This is to protect confidential information that's going to be shared. And as a buyer, you do want it to be mutual, because there will, while it's almost the lion's share is you getting information on the target, there may be some due diligence in the other direction, depending on how this is structured, whether they want to look into you to see if you're worthy of credit worthy to perform the acquisition, and they may want just other general information as well. So you want the non-disclosure agreement to be mutual. There's a lot of times you get these, they're off the shelf. People don't have an attorney prepare it. Normally, I always caution against that for documents in general, but an NDA is something where you have the highest likelihood of, if you just pull something off of a shelf or even get it on the internet, there's a high chance that it's going to be good, or at least suitable for your needs, because they don't vary too much. It's boilerplate. There's common definitions for what confidential information is, but you should always have it reviewed, because one time out of 10, there may be surprises in NDA that's either prepared by the other side or was just gotten from some other source. You may see some restrictive covenants in it that are more comprehensive than what would be appropriate for an NDA. Things like preventing you from hiring any of their employees if you happen to be, say the deal doesn't go through, but you're hiring later and one of their employees applies for a job position. You don't want just some NDA that you gave little thought to on a deal that never went anywhere to be able to hang you up as to who you can hire. There may also be, it may address, who can the information be shared with outside of who the actual parties are. You could have, well, there will be advisors in the due diligence process who will want to look at what all the information is, and do you require each of those advisors to sign a joinder to the NDA, or do you take an approach that's more common, which is to say, it's understandable that you want to share information more than just the company that's signing it, and that company will assume responsibility for if there's a breach by any of those representatives or advisors. When an NDA is signed, you still want to be cautious with the due diligence, especially early on, especially before you've received a clear offer of what the deal will be. Because enforcing an NDA isn't the easiest thing in the world. If someone disclosed something, if it was done through email or if it was done verbally or without witnesses, the evidence that you would need to prove a breach can often be very challenging. And you may have to go down the expensive road of a lawsuit and discovery just to see if there's even the type of evidence that would entitle you to recover. So don't feel that an NDA is bulletproof armor, or that now the seller is going to be forthcoming with everything immediately now that an NDA has been signed. A lot of sellers are cautious and they think, well, is this buyer legitimate, or are they just going on a fishing expedition trying to learn some information about me, and now they'll use that information to compete against me more effectively, or maybe they have several irons in the fire and they decide on another company that's like mine and they got information from me that they can use to their competitive advantage. So
yeah, I was to say, this step is important here, because this is where the first exchange of some level of information starts to occur, right? Like typically there's at least some basic financial statements or tax returns that need to be exchanged between the parties. Otherwise, it's hard to move into that, well, what's your offer look like? Well, I don't know until I see how you're performing and what your company looks like from a financial standpoint, to know what impact it will have on us as the acquirer. So
Yeah, and when we talk about due diligence, there's early due diligence and continuing and later due diligence. There does have to be enough information shared so that a true offer can be put together. So you often see financial statements and tax returns. When I represent sellers, I caution them to be hesitant on any further due diligence. You'll sometimes have a very large list that goes on for 5-6 pages in small print of all the different questions and types of documents they want turned over. And sometimes a buyer will jump the gun and send that over very early in the process, even before a letter of intent or a clearly articulated offer. And that can rub a seller the wrong way and think that, well, just trying to get an information grab. The letter of intent is not a mandatory part of the process, but it's advised. And I certainly always advise it for the buyer, because there are protections that every buyer should want to have in a letter of intent. First, a letter of intent is not binding, or at least it shouldn't be binding if it's well prepared. If you just lay out all the terms and sign it, there can be ambiguity. And if the deal falls through, one party can say, well, this was actually a real binding agreement, and I suffered some substantial losses from not being able to do this deal. So you want it to be clear that the economic terms in the letter of intent are all non-binding, and either party can walk away from it if they get cold feet over those terms before a true definitive purchase agreement has been signed. With the letter of intent, you want to approach it like Goldilocks, where you don't want it to be too small, you don't want it to be too large, you want it to be just right. If it's too basic, you can get into the binding, non-binding issue, and you lose all the protections that you want to have. If you expend too much effort on it, now it becomes a large project early on in the process, and it raises the question, well, why are we even doing this with the letter of intent? Let's just jump to the definitive agreement if we're going to cover everything and anything in the letter of intent. So you want to come from a place of experience of what are the important things to cover in the letter of intent, what's okay to kick the can down the road on. You do want to define the price, the basic terms. We'll get into different types of funding and structure later, and you do want to have the general funding in the letter of intent. You may want to hold back on representations and warranties and how much liability caps are there after the deal, the more technical terms of the deal. That should be left to the true purchase agreement and hold off on the letter of intent. From a strategy standpoint, you do want to, if the tax motivation for buying it for your structure is important, you would want to lock in that structure. Say whether it's a stock sale or an asset sale, if you're going to do a special election to get you tax treatment, you want that in the letter of intent to begin with. Because if you don't, if you present it as kind of open, the buyer can say, well, I was expecting a stock sale and capital gain for everything. And if now you're presenting something different, I want a gross up to make me whole for what I thought I was going to get in after-tax dollars. So give consideration to the structure before the letter of intent and put that in. Protection for the buyer is exclusivity. If you're going to go down the road of the more comprehensive due diligence and putting together a long, thorough purchase agreement, that's a big investment, and you don't want a seller who could be out negotiating with other people, or a better deal could come along while you're waiting to close yours, and then they leave you for that other deal. So you want exclusivity in the letter of intent. And it's common to do 90 days, 120 days, but sometimes circumstances warrant even more. So you want to think about how long should the seller be locked into exclusive negotiation with me by signing the letter of intent. After a letter of intent is signed, that's when you get into the more comprehensive due diligence. And we will talk about the due diligence in depth in slides to come. So for the overview, just wanted to communicate, which we did already, early due diligence versus the later due diligence. And as you are performing the due diligence and getting towards the end of it, that's when the definitive transaction documents are prepared. And depending on the structure, there may be several, or there may be a whole host of ancillary documents to the purchase agreement. It's good to be working on them early, but there are some buyers who, for strategic reasons, will hold off as long as possible on producing an initial draft of that document. I don't really like that approach, but the strategy behind it is, if you put a time crunch on the seller to review this document and get towards the finish line, and you're enticing them with the idea of the payday that's coming if they can get through the rest of the deal quickly, you may not get as much pushback on the negotiation of some of the terms that you put in the purchase agreement. But the reason I don't like that approach is because if you have a savvy seller with competent counsel, they will pump the brakes. They won't just go along with your frame for the timing, and it could end up delaying everything and say, we really need time to absorb this and analyze it and come up with our comments. So if you want to get the deal done quickly, you could harm yourself by playing that game with when to present the purchase agreement. Once the agreement is signed, and sometimes you sign at the same time as you close, sometimes you sign and then you have to do a number of things before closing. You reach the settlement. That's when the business becomes yours, but that may not be the end of things, because part of the offer that gets presented is, what is the post-closing relationship going to be? Do you require the seller to stick around and provide transition services? And is that going to be short-term or long-term? And that should be part of the transaction documents. Will there be a consulting agreement or an employee agreement? How long will that be? How locked in will it be? So settlement is not always the end of the story. Anything to add, Steve, before we move on?
No, I was just gonna say this lays out a bit of just what the process looks like. So, identify your target. The NDA allows for a minor exchange of some information to at least give you enough to put together a summary of the transaction in the form of a letter of intent. Then the due diligence is performed on the target, which is really to verify the assumptions that were used in developing the letter of intent, and identifying some things that may not have come up in the conversations. You put the documents together, and then you have the settlement. So, yep, that's it. The next piece of it is, and I'm not in any particular order here, but obviously you're making an acquisition for a reason, right? And I think it's important to understand what the impact that acquisition is going to have on the operations of your existing business. A couple of key things is, what impact is it going to have to my balance sheet? A lot of times these transactions involve taking on some additional debt as part of it. It's rare that a company will come to the table with an all cash deal unless it's a pretty small one. And even if they do, there's the balance of, like we said, one of the things that's driving a lot of the heavy merger and acquisition market right now is the fact that interest rates are pretty low. So it might be worth, in some instances, to borrow some relatively inexpensive capital from a bank, probably the most common place to borrow it from, and deploy that rather than tie up the working capital cash of a business for a transaction. So you do want to understand what impact the acquisition is going to have on the overall balance sheet of the company. And also, and I think more importantly, is what are the expected cash flows that are expected to generate. There's usually some form of synergy expectation that happens, right? You as an existing company have your marketing team. You might have your finance and accounting team. The target company has their own marketing team and their own finance and accounting team. You bring them together. Do you really need to have that amount? Do you really need to double the size of those departments? Or there may be some measures where some of those areas you may be able to uh, gain the efficiency of the economies of scale, and maybe even buying power from purchasing raw materials, right? From a vendor, you might be able to get at some deeper discounts because now you're buying in some greater volume. So just modeling out and understanding what the expected impact is to the existing business is pretty important, because you want to make sure you don't over stress the company. Like Sally said at the beginning, these the acquisitions don't always work out perfectly, and so they can cause some disruption, and you just want to make sure you don't put your core business at risk. So I don't have any really type of rule of thumb there, but I think as a, a big example, if you're a $10 million company and you're buying another $10 million company to double the size, there's some pretty substantial risk involved in a transaction of that size. Where if you're a $10 million company and you're looking to bolt on maybe $1 million company, right? The impact, if that doesn't go well, is not that it's not going to sting a little bit, but it would be far less disruptive to the overall business. So the the other piece is right. The other, I'm talking about that stuff. So doing those financial projections, a lot of times where at least we've been able to help our clients in that scenario is look at some historical financials and then just layer on what their balance sheet, what their income statement and the cash flows would look like using a set of assumptions. So if we buy this company and we borrow X amount of dollars from the bank, and this acquisition adds an additional X amount of dollars to our cash flows, what is our ability to repay this, and what additional benefit do we receive from this acquisition? It's certainly a question if you do pursue third party funding with a bank anyway. They are going to ask that question. They are going to want to know the answer to that. So and they're asking it for a very valid reason, and it would be no different. It shouldn't be any less of a reason than you as the owners of the the acquiring business would want to know as well. So next slide. Yes. So valuation, how much do I pay, right? What's a fair offer? That's a pretty common, typical question that comes out through the process. A target may have a number in their mind. And so if that becomes part of the discussion, a lot of times our clients as the buyers are wondering, hey, is that reasonable? Does that seem fair? So to break it down in how you would go about evaluating it is, I go back to a very basic formula that I learned when I was going through my valuation training is, what is value? It's a benefit stream, and it's the risks related to that benefit stream that determine the value of something, right? So a $1 million a year benefit stream that's concentrated with one customer, the work is no long-term contracts. It's heavily performed by the owner of a company that's looking to get out, right? All of a sudden, how much you as a buyer would be willing to pay for a business that, hey, that $1 million sounds great, but it comes with a significant amount of risk, versus that same $1 million additional benefit stream with a target company that's got sophisticated management. There's not a reliance on the owner. There's multiple, there's no customer concentrations. There's long-term contracts associated with it, right? You would be willing to pay more for a business like that than the other. So when looking at a target, and at the front end, when you're receiving that first pass of information, that financial information in that NDA phase that we referenced earlier, this is some of the basic analysis. You're just trying to get your arms around what is the benefit stream, right? And ask some questions of the target, trying to get a sense as to what those risks are related to that benefit stream. That is what helps you determine what an offer, a fair offer would look like to that buyer. There's other sources of information. I know at our firm, we subscribe to a handful of databases that give us some insight into some private transactions that are occurring. So we'll also look at those as a reference point to say, hey, if I'm a HVAC company, for instance, what have, in the past 5 years, what have HVAC companies sold for that have reported to these databases? And it will give some information about how much was paid, the size of the company that was, the size of the deal, the size of the company that was acquired. And there's a variety of different types of multiples that they'll imply, whether it's a multiple of revenue, a multiple of the EBITDA, the earnings before interest, taxes, depreciation, and amortization that's in this database that you can extract and apply to your situation as at least a check, a sounding board as to, hey, are we in the ballpark for things? So that is what, when looking at that valuation side of things, is how to go about looking at that.
Just something to add quick
Yeah.
on the valuation. When you're presenting the offer, if you don't do a thorough or precise job in coming up with the value, you see this sometimes. The letter of intent may say to be determined, or may have a range of values that it's going to fall under. And that isn't received the best by a seller, because the seller is just going to assume, well, the lowest end of this range, and also what's going to happen on the rest of the due diligence. Are they going to be looking to try to whittle down this purchase price for every little thing they find? So it projects that the entire transaction is going to be more concrete, that it's not going to be flapping in the wind the whole time, if you can come up with a precise offer at the time of the letter of intent.
Yep. And thank you, Andrew. And just one more thing I was just going to add, Sally. The last thing is, so the NDA, that initial exchange of information, allows you to get an idea of a value, and then just tying that into the due diligence is then the process you're going through to do some level of confirmation around those assumptions that went into it. So you do some work to confirm the revenue levels, to confirm the expenses, to identify any type of normalizing add backs, whether it's one-time expenses or discretionary type expenses that you as the buyer may not employ. So sometimes the smaller businesses will have much more in the way of, I'll call, owner perks that you as a company buying may not extend as many of those perks to those that you would have. And so just knowing what some of those add backs are will also impact the overall value of things. So thank you. Here we talked a little bit about it, and we'll go into a few more things, but the role of due diligence, again, is to gain comfort with the benefit stream that's being acquired, or in the case where you're buying certain assets of a company, it's doing some assurance around what those assets are that you're acquiring. If you're buying inventory and the target company has said, hey, this inventory is worth $500,000, well, you don't just blindly go and pay for that, right? For $500,000, there's a level of some verification of looking at the inventory, seeing how much, it was paid for, how good is it. A lot of times their companies will keep inventory. I find this a lot in private companies. They're very concerned with running out of inventory. So um, I'll sometimes see a fair amount of some inventory that might not be useful to you as the buyer. So you certainly don't want to pay for that. And then kicking the tires again on the revenues expenses. This is also where you can start to evaluate some of the risks that at least have come up in the conversation, right? What's the level of customer concentration? So looking at, a revenue by customer. What is the concentration of knowledge with some of the key employees of the company, or at least of the owner, the person that is looking to sell? What is going with them in that they know, that hasn't been translated down to the rest of the team? The other piece of it has to do with, at least on the financial side of things, identifying where there could be some unknown risks or some exposures that may come up. Uh, we are seeing now, for sure, so many states in our country had been running at some deficit type levels pre-pandemic. That has only amplified itself over the past year, and we are starting to see states becoming significantly more aggressive in terms of identifying companies that are conducting business in their state and pulling them into their tax paying base. Major changes occurred a few years ago with maybe heard of it, the Wayfair decision. So the online company Wayfair, which many of you may be familiar with, lost a tax case with North Dakota that said, hey, you're shipping a ton of product into our state. The old rules used to be that Wayfair would have needed to have a physical presence in North Dakota in order to charge and remit sales tax for products that were shipped into North Dakota. The Wayfair decision that went up through the Supreme Court identified that it doesn't matter, at least from a sales tax perspective. I want to clarify whether or not you have a physical presence. They defined in that ruling something called economic nexus that sets a dollar threshold. So if you sell more than $100,000 or $250,000 worth of sales into our state, that is going to trigger an economic nexus, which means that you are now required to, collect and remit sales tax into our state. Because it's so, as our economy has shifted and this presence of online has made it so much easier from an exchange of goods perspective. So many companies, especially if you're identifying a smaller business, often don't have the resources in-house to manage and navigate that aspect of it very effectively. And so it is something that you, though, as the buyer, should know, right? And it also dovetails into other types of unrecorded liabilities that could be on the books. Some of it could be, I'll just say, ordinary types of expenses that we in the accounting profession will refer to as cutoff issues. So things like, have expenses been incurred, but not reflected as a liability because the business has a practice of just recording expenses as they're paid. Very, very different. So one of the things you as the buyer want to know is that the target company did not incur a bunch of expenses and then after post transaction, right, you are expected to pay for these services because the owners are like, well, I no longer own the business anymore. So there's certain things, unrecorded liabilities from that perspective. And then as Andrew will probably talk into, there's certainly some unrecorded legal items as well. So.
Yeah, and when the agreement is drafted, there are defenses or protections that you can put into it for if the business is not as expected, if there's broken promises about what they represented. But you really want to use the due diligence period to try to suss out any potential problems before you go into the transaction. It's better to have, clear eyes and perhaps adjust some terms of the deal, or even back out if you see it's just too risky to acquire it, rather than to do it and then just rely on legal means of redress through the agreement later. The focus is usually first on the financial aspects of it, just to verify that the offer that you made is appropriate. But it's important to go down the road on legal as well, identifying potential risks. And Steve was touching on that some. In the potential tax liabilities are a big deal, because no matter how you structure this deal, a taxing authority can go after the successor. Even if you just bought the assets and assigned the assets over, taxing authority, it's very easy to just cut through that and go to the company that's running the business now and say that they're on the hook for these tax liabilities. So that's something to be hyper concerned about. And you can do lien searches on the business, on the individuals behind the business. That is often a good way of tipping off if there are tax liabilities. And of course, getting the past returns and do an analysis of those. You want to look at the company's governing and formation documents. If there's a problem with how it was created, or if there's not clarity as to who the owners are or who the decision makers are, say in the bylaws of the company, you don't want to have an issue with, well, are the people who you were dealing with, were they actually authorized to pull the trigger on the deal? Or did the owners actually own it? Or is there someone out there who had stock in the past, and maybe the way that their buyout was conducted, it's not entirely clear that went through, or maybe there's some other kind of contract that gives rights that are similar to those of a shareholder, and do they have to be involved in it? So you do want to get into what this business is, and are there any deficiencies in the corporate book and related documents that either have to be fixed before closing or just have to be accounted for in how we approach the deal. You want to look at contracts of all kinds that the company is bound to, and see if there are special warranties that have been made that could subject the company to liability. Do they protect themselves in contracts with customers or with suppliers, so that they're not agreeing to harsh indemnification terms where they could have to protect some other company, that they won't have unlimited liability that lasts for either a very long time or unlimited time. And you want to know what the potential is, even if there aren't any active lawsuits now, what's the history of lawsuits? What contracts are they subject to that the lawsuits could be governed by? And could there be a long tail on the potential for liability events to spring up after the closing?
And Andrew, I would add too, even on especially in the contracts, depending on who the customers of the target are, some of those contracts will often have clauses in them that say if there is a change of control event, it requires either a notification or an approval of the buyer. Then you have to redo a lot of those contracts. And so I think what that can present is just a risk from how many of these, I'm buying this company because I'm expecting a certain level of customer and recurring sales. But if I have to go back and renegotiate or, change all of those contracts because there's a change of control event, does that add a risk that I might not retain as many of these customers that I'm expecting to get, and can also be a pretty big driver in what we're going to talk about a little bit in our next slide. I don't know if we're there yet or not, but in terms of how a deal is structured because of that. So
Yeah, excellent point, Steve. And just to piggyback off of that, you will, it can be due diligence. It's also part of the agreement and disclosure schedules that get put together, and what the conditions are of closing. Any contracts that require third-party consents, or if there's a termination right upon a change of ownership that could be exercised and getting a waiver of that termination right, you want to be aware of that. And even if you don't dive into it real deep on the initial due diligence, you want to have protections in the agreement that spring up pre-closing, so that all of that gets taken care of and everything can transition over to the buyer and have it be more seamless. You don't want to be, losing all kinds of contracts because of those terms that are in it. And another example of this, Steve talked about having to change contracts. Sometimes that can be a very big project. I have a deal that's pending now where it's a medical related field. It's kind of like technology that's used by different physicians, and they have medical practices as their clients. And you get into something called the Stark rules about referring to yourself, and how that relationship can bring up risk if you run afoul of these federal laws. And the buyer determined that the contracts, because the seller was pretty loosey-goosey about how they went about drafting their contracts and entering into them, kind of just doing it all on their own. There were some deficiencies in them, and they had to actually redo all of them, which was about 10. And they were able to get it done, but it presented an issue that really could have sunk the deal if there wasn't cooperation for getting them changed.
And here, just you'll hear this a lot if in terms of from a structure perspective, you know, the difference between an asset versus a stock deal, right? So in any transaction, you are either acquiring directly the stock of the buyer, which represents a controlling element of all the decisions of what that company owns, or you're identifying specific assets that you're interested in buying. And those assets can come in the form of both tangible and intangible assets. And when you're buying a company, it's not just buying their accounts receivable and their inventory, right? It's that you're buying their customer list, you're buying their processes, you might be buying their website in terms of how they attract customers to themselves. So in an asset acquisition, you're identifying the specific assets that you are going to buy. There can be some form of liabilities that you may naturally assume with that deal as well. The advantage of an asset acquisition, which is typically, not always, but typically preferable for the buyer of a company, is because you get what's called a step up in basis in terms of those assets that you are buying. So take, for instance, if you're buying equipment of a company, you get to revalue what the value of that equipment is. And when you allocate your purchase price, you allocate it to the different buckets of the things that you are buying. And by doing that, you can get a step up in basis, which means if I'm buying equipment that the target company has valued on the books of $50,000 because they bought it a while ago and it's depreciated its way down. In an asset acquisition, if that equipment has a value of $100,000, you would then you would be able to get that step up, if you will, record it on your books at 100,000 and depreciate it at that higher amount. The depreciation for an asset like that is an ordinary tax deduction from a tax perspective. So the asset acquisitions tend to be a little more tax efficient from the buyer's side of things.
Yeah, agreed. And in addition to the tax benefit, there's also, liability protection. If you buy the assets, it's more difficult for a creditor of the target to come after you as the successor most of the time. Talked about the taxing authorities before, how they can come through easily. And there can always be theories of successor liability, but it's an extra hoop to jump through, and it's just better protection for the buyer if it's an asset purchase.
Right. And
Some examples of why you might actually prefer stock instead of an asset deal, or just factors that could mitigate and perhaps push it the other way, is what about the complexity of having to transfer everything over as the assets? Are there, permits, licenses, registrations that now have to be redone? And does it take a long time to get those up and running? If we do an asset sale, where if you do a stock sale and step into the already existing business, they continue to exist and you don't have to do anything about them. I've seen situations where, say, like a fleet of vehicles are being considered for an asset sale, and that has its own income tax hit associated with it that could, push it the other direction on the tax analysis. So it's not always cut and dry, but general approach is the buyer prefers it to be an asset purchase.
right. And there's these other added steps that we listed down at the bottom for the asset acquisition. That means then that all of the target company's employees, right, they have to be rehired by you as the buyer, and any contracts that are in place would need to be reassigned over to you as the buyer. And so those are some hurdles that may or may not be of significance, but will have an impact on the approach you take from, especially when the letter of intent is being drafted as to which way you would go. The only other piece I want to comment on the stock acquisition side of things is, again, that's where you're just buying the existing stock of the company, and now you as the buyer have the control over everything that entity owns. So the target company's entity does not go away. It just becomes a subsidiary of your existing entity. And sometimes you might have a blocker, and acquisition company in between from a liability perspective. Not always the case, but in a stock acquisition, there is an important tax election called the 338H10, which is pretty commonly used, where you as the buyer can get the best of both worlds in terms of it's from a, and Andrew, you back me up here, from a legal perspective, it's still considered a stock acquisition, but
Right.
this is a tax election that allows the buyer to treat the transaction as if it was an asset acquisition.
Mhm.
So in that case, you do get the benefits of the step up, and you get the benefits of not having to like retitle contracts, and so on in that case. One of the negotiation points, though, right, and will depend on it, that has a very different tax treatment to a seller. And so in that instance, in a stock acquisition at a very high level, the seller is paying capital gains rates on the sale of their stock, no different than if you were to sell, buy shares of Apple and then sell them 2 years later. The difference between what you paid for it and then what you sold it for is the gain, and that's taxed at a long-term capital gain treatment if you've owned the stock for more than a year. Same concept applies in a private company situation where the difference between what the owners have in terms of their basis in the stock versus what they sell it for, that difference becomes capital gain treatment as long as they've held that stock for more than a year. Whereas in an asset acquisition, you go through a allocation of purchase price and you say, okay, we're going to pay you X amount of dollars. We're going to pay you $1 million for your accounts receivable. How much do you have it recorded on your books for from a tax perspective? And the difference for an asset like accounts receivable is taxed at an ordinary income tax rate, not the preferred capital gain tax rate. And so you go through that iteration. We could do, did not include, because of some time constraints, like a whole illustration to walk through that. We could, if that's of interest to people, we can certainly model out and show the differences, and maybe that's for a future follow-up to get into a little bit more detail on that front. But just know that there is a tax difference and your incentives are almost misaligned, right? The buyer wants to do an asset acquisition. The seller typically wants to do a stock acquisition. And so you're trying to bridge that with what you do in terms of the letter of intent. And we'll talk a little bit later on from additional structure considerations to bridge some of those gaps. So
a couple notes to add with the 338H10 election. If you do plan to use it, bring it to the table early, because I've seen a handful of times in deals where I've represented the seller and the transaction is proposed as a stock purchase, and that's all it says in the letter of intent. And then we get to the purchase agreement, and the purchase agreement, now they've introduced the 338H10 election, sometimes without even saying it, it's just there in the agreement, or sometimes they bring it up a little later. And if it was only presented as a stock purchase before, the buyer or the seller has a basis to say, well, this changes the deal fundamentally because of the tax consequences. So I need to be made whole for what my tax difference is going to be. So, and I've seen that be agreed to a number of times. So you're reducing the benefit you would get from the election if you don't bring it early, because you could just have to pay them back the money that you're saving in the better tax treatment. The other note is on, and this is just on structure in general, who will the purchaser be? If it's just your existing company and you're buying the assets into it, that creates a liability risk where any liability associated with the company you're buying, and not just looking back, but the operations going forward, that's going to be combined with your existing business, and all the assets of the combined business are fair game if there's a liability event for one of them. So consider, forming a new entity to take over this company that you're acquiring. So you isolate all the liability, past, present, and future, once the deal is complete. You want to protect the business you already have and not subject it to undue risk. So next slide. There's a difference between whether you sign the purchase agreement first and close later, or whether you have a simultaneous sign and close. Usually a buyer wants to do the former, which is get a legally binding agreement in place where now you just have a set of conditions that are laid out that have to be completed before you close, but your seller is not going anywhere while you have this agreement signed. It captures them even more effectively than that exclusivity period that's in the letter of intent. And sometimes you have no choice but to present it this way. I have another pending deal, which is of an auto dealership where they have to get the consent of the manufacturer. And for that, you have to have a signed agreement and show them all the details of that before they give their consent. So you have to sign first and have some conditions that get met, and then you close later. A sign and close deal simultaneous, that can, it can benefit the seller, but not always, just because it gives ongoing flexibility. It also means you can be negotiating terms right up to the end. And then you're, as the buyer, you're focusing more on, well, what are all the promises that are being made about the company, rather than covenants and conditions that come in after we sign the agreement. And if you're taking that approach, you also have to worry about, am I running out of time on my exclusivity? Do we have to extend it, or do we have to put the screws to the seller? So that's, did you have anything on that topic, Steve?
I did not.
Next slide. And this is the structure of how you might fund a deal. And there are numerous different ways, and it can be combinations of these types of structures. Obviously, the seller would love it just to all be cash, or a bank finance deal where they're walking away with 100% of everything at the closing and don't have to worry about being paid anything going forward. But as the buyer, you may want to keep an escrow or a holdback to secure against post-closing liabilities, or if we haven't talked about working capital yet, but if there is a working capital adjustment, you may want an escrow to secure yourself for that. So even if it is a cash and bank finance deal, there may be some holdbacks from it. A seller held note isn't looked at the best by the seller, because they're essentially being your bank for at least a portion of the deal if you're not paying them the full amount. And then they might get into, well, what due diligence are they going to do on the buyer, and what kind of security do they ask for, and do they want personal guarantees of the buyer's owners, or do they want collateral posted for that? So it can complicate it if you want to have a seller held note. Earnouts also are not looked at favorably unless you're anticipating a long-term relationship post-closing, where you're acquiring but keeping key personnel or the former owner in a long-term role, and you want some of the purchase price to be contingent upon the future performance actually taking place. I had a deal that closed recently where it was a 10 million price, and as they were developing the agreement and doing due diligence, the buyer recognized that the state of New York was a client and was a large portion of the income, and they were unwilling to sign any kind of a commitment that they're going to continue doing business with the buyer when this business changes hands. Although they say, we will treat you the same, but we're not signing anything, we're not putting anything in writing. So the buyer wanted to make 3 million of the 10 million in earnout. And we resisted it, and we ultimately negotiated to not have that. But that's just part of the analysis of what is the future income based on, and does it warrant having some of it be contingent upon the future performance and not guaranteed. You also may want to shift some of the purchase price to a post-closing compensation agreement. And you may have an agreement that's just fair market value for the services, and that's totally on top of the purchase price that was in the offer. Or it may be to the buyer's advantage to say, well, we're actually going to move some of the purchase price to post-closing compensation. And it turns into either above market compensation or just guaranteed for a long period of time. That's generally favorable to the buyer if you have a structure like that. And you also want to think about, well, what's the premises that's being used? Are you rolling it into your own? Will you be maintaining a separate location? And if so, who owns that property? Is a lot of times it's connected with the seller and they retain that property. And then now do you have to have a lease with the party that you're buying from? So those are things that go into the structure. And anything to add on that, Steve?
Other than this part, for me, is always the fun part, because we get to be, especially if you're working with a relatively friendly party, you can get creative in terms of how the the structure of the deal works. And this will again dovetail back into why, you know, how it impacts the cash flows of you as the company. The only other things I would just like, you know, comment and add on is that in terms of if you are pursuing bank financing, is that there may be some requirements from the bank. A lot of them are not going to just, you know, lend blindly for an acquisition uh, dollars, but they may ask for certain things like a quality of earnings on the target company or a business valuation of the target company. They may ask for either forecasts or projections from you as the buyer as to what this looks like at the end of the day. The only other thing I would just comment on is in terms of each of these have a reason as to why you would use them. You know, in an instance where seller held notes can be a way to bridge the gap if there is you know, a bank is unwilling to fund the entire, you know, a larger amount. They might be capped with how much they're willing to lend in a transaction. And that's where you might be able to, if especially if a seller is sort of headset on a certain dollar amount, it could be a way to bridge the difference between what you pay in cash and where a bank might be willing to lend. You can ask the seller to take back some paper. To Andrew's point, from a seller's perspective, it's less desirable because it presents credit risk. But from you as the buyer, it provides you with some level of leverage back to the buyer. So it's a better thing from a buyer's perspective. And the same with the earnout. Like the earnouts are used when you're trying to bridge the gap between values, right? Where you know, a seller is saying, hey, I think these cash flows are easily going to be $1 million a year. And you as the buyer, after doing the due diligence, are saying, hey, I don't think it's really going to be that much. An earnout is a way to say, you as the buyer are willing to pay that extra consideration if that cash flow does end up being that $1 million. So it's a way to help bridge the gap between some expectations. So, and then anything we can do to convert payment streams into expenses of the company is highly more tax efficient from the buyer's perspective. And so that's where the use of those last two bullet points can come into play. I know we're running close on time here, Sally, so we could probably move along.
So with the legal considerations, we won't get into all the details on these because of time, but I do want to say that there are a couple areas that can lead to, you know, disputes or all-out litigation after the closing, and you want to be, you know, considering those as you approach the deal and how you draft the purchase agreement. And it does tie into these bullet points here of, well, what are all the representations and warranties that the seller makes. You know, the purchase agreement is often a very large document, especially in the high dollar value deals. And you ask, well, it doesn't take that long to describe, you know, what it is we're buying and what the price is in those terms. Why is it a 50-page document? Well, it can go on and on with a series of promises that the seller makes as to the condition of the business. And there can be certain things like, we actually own the business and we have authority to sell it. It could be things like, you know, environmental hazards that exist on the premises. Lately, it's becoming more popular to have data security be something where if there's you know, what practices have you been engaged in before and who's going to be responsible if it turns out that there was a data breach that occurred in the past. So all these promises that are made about the company, and then all the covenants that you make of, you know, that after you sign the agreement, you're not going to do anything very different with the business. You're not going to depart from the ordinary course and, you know, impact what the business is and what its worth is. Post-closing, you may have non-competes, non-solicitation covenants. If any of those are breached and you find out that they were breached after the closing, you have something called indemnification, which means that the seller would be responsible because the seller is ultimately at fault. They made a false promise, or they didn't do something they were supposed to do, that something was misrepresented, and it impacts the value of what you got in the business. So the indemnification terms in the agreement should be well thought out and crafted. There should also be reasonable limits on it. You want the seller to be able to sleep at night so that they don't think, 10 years down the road, I'm going to have all of my purchase price clawed back from me because something came up. But you want to have terms that work for both sides. It's often hotly negotiated, and you can have an escrow, you can have a holdback for a year, sometimes to 2 years even, to secure these obligations, because the buyer doesn't want to have to chase down the seller who may have spent all the money or converted it into things that aren't easy to collect against. So having an escrow, having a holdback gives the buyer some security. The other post-closing dispute potential is with working capital, where if you came up with a value for the business, but does that mean you're okay with it being a totally emptied out business where you don't have any current assets? What are the receivables compared to the payables? Do you have to dig into your own pocket and kick money into the company now to make up a working capital shortfall? So you want to think about, do I need more in the company in the way of working capital? Do we have to set some kind of a target? And that should be done early on, even as part of the due diligence process of what's an appropriate target to set for the working capital. We do a dry run to make sure everyone's on the same page, because after closing, when you do the look back and see, well, what was the working capital actually on the date of closing, you may have a disagreement with the accountants on buyer side versus accountants on seller side. If you did a dry run of it based on a prior date earlier on, you reduce the chance that you could have a dispute. And I've seen working capital disputes get very large. And most of the time, it's something small enough that you can settle it. You can split the baby sometimes, even if you don't resolve the disagreement. But sometimes it can be huge. It can even mean millions of dollars in the way of a working capital adjustment. And then you find yourself in a lawsuit to resolve that. So those are the big legal considerations to think about.
And I know we're closing in on our time, so I was actually, Sally, I was going to say, if you want to flip to that, if there are any questions.
Yes, we don't see any questions that are posted, but if you do, we have a few minutes for questions. And I also like to mention that Steve and Andrew are very open to a phone call or an email to respond, because I know many of your questions might be more detailed or, to your specific case. So maybe just pause here for a minute, or any other comments that you would have, either Steve or Andrew.
Well, I would, the only thing I would say is that, through a lot of things, having some patience through a process like this, I think is important. And also, don't force it. Sometimes you get into a deal that, and it can lead to a little bit of, we call like deal fatigue, right? Where it just seems like it's taking longer and longer, and it's pulling on people. And sometimes the answer is, all right, we've already invested all this time, let's just go through with it. And if you're not having that feeling about it, that it's you should feel good on the outside when you get to that settlement, that this is really going to be beneficial. So I would just say be patient and don't force.
Yeah, also, there's always going to be some measure of trust involved. And you'll have the detailed legal documents, you'll perform the due diligence, but you put real importance on who it is, this company that you're acquiring, the people involved. And when it comes down to it, do you trust them? Because it's not ideal to rely on all the legal protections in the documents. I mean, it's certainly a whole lot better than not having them, but if your spidey senses are tingling about something, like Steve said, don't feel that you have to go through with it just because you've gone partially down the road. Be willing to be flexible. Be like, you know, a center fielder who's reacting to where the ball's hit rather than, you know, trying to force yourself into a certain direction.
I really affirm both of what you just said, and also make sure you have the right team. This is something you don't want to do alone. Get the right team and also trust your advisors. And I know I've heard other stories from Steve and Andrew and myself. So get a good team. Okay, well then we are going to thank you so much, Steve and Andrew, for your input. Really helpful. And again, they are open to questions by email or give them a phone call. You can access these slides later. And a word about upcoming programs. We have another one yet in May that I mentioned in the beginning. May 27, we're going to focus on the board mountain. We already looked at the family mountain. 2 weeks ago, we focused on the shareholder mountain. May 27 will be the board mountain. We'll hear from Dave Griffith and Julia Klein, who were both CEOs in their family businesses. Dave, it was his wife's family business, and then they moved on to being a board chair, and they also serve on other family business boards and other boards as well. And Henry Landis will also be providing some input at that one. Then June 22, we'll be moving on to the management mountain, the Blue Mountain, and we'll hear from two members, Brandon McBall from Laboratory Testing and Jim Smucker from Keim. So that'll be quite interesting. And then we'll move on to the Advisor Mountain on September 23, herding cats. So stay tuned for that. And we have another best practice event planned for July 15. That's like today. We do some events that are more technical. And we'll be talking about the do's and don'ts of buy-sell agreements for family businesses. So Ian and Mike will be providing input on that. So thank you for joining us today. Again, feel free to reach out to any one of us, and you will have access if you just go on the member part of our website to access the slides. So thank you, Steve and Andrew.
Great. No, thank you.
Thank you, everyone.
Thanks everyone for joining. Bye-bye.